Hello and welcome to Livewire Markets. I'm Ali Selby, and in this Fund in Focus we're joined by Michael Wayne from Medallion Financial for a deep dive into the firm's new Australian Equities Growth Fund. Thank you so much for joining us today, Michael.
Thanks, Ali, for having me.
The fund's been running for about a year now. How's it performed so far?
Yeah, so we're coming up to the 12-month anniversary, and so far, fortunately, we've had a particularly good start, which is always a nice thing, where the portfolio, looking at the live data as of today, is about 14% higher versus the market slightly above 9%. And that's in a year where we've carried a fair amount of cash as well. So the cash drag has been significant, which in retrospect is a little bit unfortunate. However, we're by no means under any illusions that 1 year makes a long-term track record. We've still got a lot of hard work to do, but it is nice to get off to a good start.
What are some of the key learnings you've taken away from the past 12 months?
It's more reinforcing some of the old learnings. The whole media noise, the media news cycle are things that I think a lot of investors can become too focused on. And if we cast our mind back to the beginning of 2023, there was all this talk of rampant inflation, interest rates going up, the US consumer being crunched, large stimulus coming out of China, a big mortgage cliff occurring in Australia. And as it turned out, none of those things played out. So there was a lot of reasons to be nervous about 2023. There was a lot of reasons to not take the risk in equities or share markets. However, as it turned out, it was quite a constructive year across the board. So often it's important to block out much of the noise and just focus in on your strategy and your way of doing things and making sure that you remain disciplined at all times.
Let's stick with your strategy. What are some of the pillars of your investment process? What's your secret sauce?
The secret sauce, look, I'm not sure there's a secret sauce per se. A lot of people engender ideas of supercomputers, algorithms placing hundreds and thousands of trades, per day or per month. But our investment strategy is very logical. We're very process driven. So what we look to do is look to identify certain themes, different changes in the economic landscape. And then once we've done that, we look to identify the sectors of the economy that are booming and benefiting from those shifts. So you can think about, for instance, the ageing population and the benefits to healthcare, the use of technology and the thirst for data and information and how that's going to benefit the technology space. So the idea is once we've done the top-down analysis, we then look to do the bottom-up company-specific analysis. And that's really the third pillar. It's where we look to identify high-quality businesses that meet a certain criteria, interesting characteristics such as consistent revenue growth, consistent earnings growth, high but expanding margins over time, high return on equity, low debt, these sorts of company-specific characteristics that we like to see in businesses. And then the final pillar is the portfolio active management around certain positions. So in many ways, that is our approach. But when you remain disciplined, it can be quite powerful how the strategy can play out over time. But the analogy we like to use is, if you think about it being a cricketer, if you're used to playing a certain way, conservatively, you're playing straight down the ground, staying in the V, it makes sense to stick with your approach rather than coming out in the next innings and trying to hit every ball for six, taking a baseball approach. So we remain within our circle of competence, and we stick to what we know, and we build high degrees of confidence in the businesses that we're investing in.
Okay, I definitely don't know anything at all about cricket, but I do know a thing or two about investing. I know that the fund is invested in small and mid-cap stocks. Why do you believe there's opportunity within this area of the market right now?
So if we look at the first slide here, what I've done is I've broken down the different segments of the ASX and looking at the performance from 2014 to 2024 year to date. And these returns are the total returns, so the capital growth plus the dividend income paid over that last 10-year period. And what we can see is over that last 10-year period, the small caps indices has returned 85.6%. The ASX top 20, so the largest household names that people are familiar with, that increased 113.5%. The ASX 200 more broadly increased 123.5% over that 10-year time frame. And then finally, we have the S&P ASX midcaps, which over the same time frame has dwarfed all other segments of the market to increase 202.6%. There's been a clear outperformance by the mid-cap part of the market, and people often don't understand what do you mean by mid-caps, what do you mean by small caps. So the mid-caps by definition is really anything ASX top 50 to ASX top 100. And small caps, for instance, is anything ASX X the top 100 up to ASX 300. So we believe that, long term, the mid-caps stand a very good chance of delivering continued outperformance. That particular chart that I put up then was looking at the last 10 years, but if you extrapolate that and take that back even further to the year 2000, the outperformance of mid-caps relative to the rest of the market is even more pronounced. So if I put up this particular chart, you can see again, this is the performance since 2014 of the mid-caps versus the other segments of the market. And again, it becomes very clear about the significant outperformance over that time.
Michael, there's obviously quite a lot of competition within the small and mid-cap market, and in addition, many of these funds fail to beat the benchmark. What are you doing to set yourself apart from the competition?
So we're index unaware when it comes to building our portfolios, so we're unconstrained in that respect. We're also high conviction. We'll happily be index unaware when picking different businesses to invest in. We're also style agnostic. We don't have a preference for growth or value. Effectively, what we're trying to identify is the best growth stocks, the best value stocks, the best small caps, the best large caps. So we're very malleable, very flexible in the way that we can go about investing in the market. So I think it can be a disservice for the fund manager and also the investors to be pigeonholed into one area or another. So having that flexibility for us, we think allows us to tap the parts of the market that are offering the best propositions at any given point in time.
It sounds like quite a broad exposure. Are there any market conditions where you feel like this fund would not perform that well?
Yes, because we're unconstrained and because we're high conviction, from time to time we might have a lot of exposure to one particular sector. There's nothing stopping us from having 30-40% of the fund in technology stocks, for instance. Likewise, there's nothing stopping us from having zero exposure to things like utilities. And from time to time, there'll be months where we outperform by a large proportion, given the benefits that might play out in one particular sector. But likewise, there might be periods of time where a certain sector is out of favour or a certain style of investing is out of favour. And if that was to play out, yes, that would be adverse for the portfolio in the short term. But again, we're taking a very long-term view. We're very disciplined in that, and we have the capacity as well to hold large cash positions. So if we do see the markets being a little bit choppy or valuations becoming too extreme, then we have the capacity to build cash, sit on the sidelines, and wait for opportunities to present themselves again.
Let's get a little bit more granular now. What have been some of the best performing positions in the portfolio over the last 12 months?
So there's been two particularly good positions, but we've been very fortunate that the breadth of the performance across the portfolio holdings has been very good. There's only really been one stock which has been down more than 10%, but the best performer in the fund and the biggest contribution has come from Audinate. You would probably know from Livewire, I've been going on about this business for a couple of years now, but over the last 12 months, it's really started to play out for that company, and we expect that the business will be able to continue to deliver in the months and years going ahead. So we're very excited about that particular company. Another business that we've held in the top 5 positions in the fund that's done very well is Altium. It's been recently acquired, which is an unfortunate end to the stanza for that particular business because it has been a very strong performer over a long period of time. So it's going to be sad to see that go.
Okay, and on the other side of that, what's been the worst? You talk about a stock being down 10%, and what was that company?
Yes, so the one stock that we've had which has been down more than 10% is Alchem, the old AKE, or now Arcadium. LTM is the code in the lithium space. So that's been the worst performer. We've been a little bit premature in jumping back into that lithium space after the big sell-offs that's been playing out across not only the underlying commodity, but the share prices of lithium producers as well. Fortunately, it's a position of around 1% in the portfolio. So we look to ease our way into that position, and the idea is that over time we can look to add to that. But that's been by far and away the worst absolute return performer in the portfolio.
We're in the midst of reporting season right now. Have you been making any additions to the portfolio during this month? Is there anything that you're feeling particularly bullish on right now?
So one of the stocks we've been adding to in the lead up to the report was GQG, the fund manager. This is a company that's got very high quality fund managers rather than one specific fund management star. The business has seen very strong fund inflows in recent times. Dividend per share growth's been very impressive. And in an industry which has generally struggled, being an equity fund manager, they've been a shining light. And in many cases, they trade at a big discount to many of their listed peers globally. So that's one particular business that we like and have been adding to recently. And the other company that we have been is ReadyTech, RDY. This is a high quality technology business. Effectively, they've been growing, they're looking to compound earnings growth of around 16 to 17% over the next 3 years. It's a business with a very high customer retention ratio. It's got high levels of recurring revenue, and it's a company that's been penalised in recent years with that shift away from high growth, unprofitable tech. However, we see a pathway for this company not only continuing to grow revenue at a very, very high number, but turn profitable in the years to come.
Well, thank you so much for coming on the show today, Michael. It was really awesome to learn all about the Australian Equities Growth Fund. If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.